Walk into any new car dealership today, and the presentation is immaculate. Clean showrooms, perfectly spaced vehicles under bright lighting, salespeople ready with confident assurances about strong demand and limited availability. The surface is polished and the narrative is consistent. What you do not see, what the presentation is specifically designed to prevent you from seeing, is what is happening behind that surface. Right now, across dealerships in every major market in the country, brand new cars are sitting, not for a few days while the paperwork processes, not for a couple of weeks while the right buyer comes along. Some of these vehicles have been on dealer lots for 90 days, for 120 days, for 180 days, untouched, undriven, and aging in ways that are costing the dealers, holding them real money every single day. And when those cars refuse to move through normal retail channels, the industry activates a set of pressure systems that most consumers have never heard of, and that reveal something important about the actual state of the market underneath the polished presentation. To understand what is happening now, you need to understand how the setup was created. The pandemic supply chain disruption compressed new vehicle inventory to historic lows, created artificial scarcity, and conditioned every participant in the market, dealers, manufacturers, and consumers alike, to operate as though demand was infinite and supply would always be the binding constraint. Manufacturers who spent 2 years unable to build enough vehicles to meet orders responded, when production finally normalized, by rebuilding output aggressively. Dealers who had been turning away customers during the shortage ordered heavily, expecting the demand environment that had made the shortage era so profitable to persist indefinitely. It did not persist. Interest rates rose sharply as the Federal Reserve moved to contain inflation, and monthly payments on new vehicles, which were already elevated because transaction prices had climbed dramatically during the shortage, crossed affordability thresholds for a substantial portion of the buyer pool. Insurance costs, already rising for structural reasons that had nothing to do with the auto market specifically, added further to the total monthly cost of vehicle ownership. The consumer, who had stretched to buy during the shortage era, motivated by the fear that waiting would mean paying even more, had already bought. The consumers who remained in the potential buyer pool were more price sensitive, more rate sensitive, and less willing to absorb the cost of ownership at current levels than the models that drove dealer inventory decisions had assumed. The result is inventory that is building faster than retail demand can absorb it. Days to turn figures, the metric that measures how long it takes a dealer to sell a vehicle after it arrives on the lot, are rising across multiple segments. Compact cars, sedans, electric vehicles, and entry-level luxury models are all showing extended holding periods that were simply not part of the recent market experience. The cars that once moved within 30 days are now sitting for 60, 90, sometimes more than 120 days. And that sitting, that daily accumulation of unsold units on lots that were ordered and financed on assumptions of faster turnover, is where the real story begins. The mechanism that makes inventory aging so financially painful for dealers is one that most consumers never think about. Because from the outside, a car lot just looks like a static display. But dealers do not own the vehicles on those lots outright. They finance inventory through floor plan loans, short-term credit facilities, typically extended by the manufacturer's captive finance arm or by independent automotive lenders. The floor plan loan allows the dealer to take delivery of vehicles without paying the full purchase price up front, which is essential for maintaining the inventory levels that a functioning dealership requires. In exchange, the dealer pays interest on the loan balance for every day the vehicle sits unsold. When days to turn are healthy, say 30 to 45 days, the floor plan interest cost is a predictable and manageable component of the transaction economics. It is absorbed within the margin the dealer earns when the vehicle sells, and the overall unit economics remain workable. When days to turn climb to 90, 120, 150 days or beyond, the accumulated interest cost on a mid-priced vehicle begins to represent a meaningful share of the expected gross profit. At the extreme end of the holding period, on higher-priced units with slower turnover, the floor plan carrying cost can actually approach or exceed the front-end gross that the dealer expected to earn on the deal. The unit that looked like a profitable sale when it arrived on the lot has become a break-even transaction or a loss by the time it finally moves. This pressure is what drives the behaviors that happen out of the consumer's line of sight. The first and most common response is the deployment of hidden incentive structures that reduce the effective transaction price without publicly altering the sticker. Dealers have access to a range of tools that accomplish this. Manufacturer rebates and dealer cash programs that are applied at the time of sale but not reflected in the advertised price. Artificially favorable trade-in valuations that subsidize the new vehicle deal at the expense of the used vehicle margin. Finance rate buydowns, where the dealer or manufacturer effectively pays part of the interest cost on the buyer's loan to reduce the monthly payment to an acceptable level. Loyalty bonuses and conquest cash programs that layer additional incentive money on eligible transactions. None of these mechanisms appear on the window sticker. The MSRP remains intact, preserving the nominal price signal that the dealer uses to anchor buyer expectations and protect the perceived value of every other unit in the same model line. The actual economics of the transaction quietly erode underneath that stable surface. A consumer who negotiates from the sticker and feels they have extracted a meaningful discount may have actually captured only a portion of the total concession that the dealer was prepared to make under the pressure of carrying costs. The opacity is structural and intentional. When local incentive deployment is not enough to move a slow unit, the next tool is geographic redistribution through dealer-to-dealer transfers. The manufacturer's network, and in many cases competing networks through wholesale broker arrangements, allows dealers to swap inventory across markets. A model or trim configuration that is overstocked in one region may have stronger demand somewhere else. A vehicle that is not moving in a high-density urban market may find a buyer more quickly in a suburban or rural environment where the use case is clearer and the buyer psychology is different. These transfers temporarily relieve the pressure on the dealer holding the unit, shifting the floor plan obligation to a dealer better positioned to move it. But they do not reduce the total volume of unsold inventory in the system. They redistribute it. The supply does not disappear. It moves. When redistribution and hidden incentives prove insufficient, the fleet channel becomes the pressure valve of choice. Rental companies, corporate fleet operators, and government purchasing programs represent bulk buyers who acquire vehicles at substantial discounts from retail pricing, often at or near dealer invoice and sometimes below it when manufacturer fleet incentives are factored in. For a dealer staring at a unit that has been accumulating floor plan interest for 4 months with no retail buyer in sight, Selling that unit into a rental fleet at a minimal margin or even a small loss represents a better outcome than continuing to carry it. The holding cost stops, the capital is freed, the lot is cleared. The downstream consequences of fleet channel sales are significant and negative for the broader market. The vehicles sold into rental fleets do not disappear from the automotive ecosystem. They depreciate through rental service and eventually re-enter the used car market as off-rental inventory, typically with a year or two of age and relatively low mileage. The volume of these used fleet units flowing back into the market adds supply pressure to the used vehicle segment, pushing resale values lower. Lower used values make trade-ins worth less, which widens the negative equity gap for consumers currently holding new vehicle loans at inflated pandemic-era prices. Wider negative equity reduces trade-in demand, which means fewer retail buyers for new vehicles, which means more new inventory sites on lots. The feedback loop operates with a delay, but it operates consistently. The electric vehicle segment is experiencing a version of this dynamic that deserves specific attention because the forces acting on it are more severe than on the broader market. EV inventory was among the most dramatically inflated in terms of transaction prices during the shortage and demand surge era. Consumers paid thousands above sticker for certain models that had waiting lists measured in months. Manufacturers responded to the apparent demand signal by expanding production capacity and pushing new model introductions. Meanwhile, the actual consumer adoption curve for EVs has been slower than the most optimistic projections assumed. Charging infrastructure concerns have persisted as genuine friction for mainstream buyers, and manufacturer price cuts have compressed the residual value of recent model used EVs in ways that have made both buyers and lenders more cautious about the category. Certain EV models are now sitting on lots significantly longer than comparable internal combustion vehicles, and the incentive spending required to move them is growing at a pace that the business cases underwriting those products did not anticipate. When incentives escalate to the point where the manufacturer's own support programs are required to clear inventory at scale, the market has moved into territory where the structural imbalance between supply and demand is no longer manageable through normal retail mechanisms. Manufacturers in this position face a choice between two options, and neither is clean. They can cut production, reducing the volume of new units flowing into an already oversupplied market, and protecting pricing integrity at the cost of factory output, labor commitments, and supplier relationships that are expensive to disrupt. Or they can continue escalating incentives, accepting the margin compression and the brand positioning risk that comes from conditioning the buyer base to expect deals. Historically, manufacturers have initially chosen the incentive path because it is less immediately disruptive and have only moved to production cuts when the incentive cost becomes clearly unsustainable. The loan risk layer sitting underneath all of this connects the inventory problem directly to consumer financial stress in ways that make the systemic picture more concerning than the retail dynamics alone would suggest. Many of the consumers who purchased new vehicles at peak pandemic-era prices did so with financing that made sense in a low-rate environment, but looks very different at current rates. They are now holding vehicles whose market value has declined meaningfully from what was paid, while their loan balances have not declined at the same pace. The negative equity position that results from that gap makes the trade cycle, the mechanism by which most consumers move from one vehicle to the next, increasingly difficult to execute. A consumer who owes significantly more on a current loan than the vehicle is worth cannot complete a trade without either paying cash to cover the gap or rolling the negative equity into a new loan, which increases the total debt load on the replacement vehicle and makes the monthly payment on the new deal higher than it would otherwise need to be. Both outcomes suppress new vehicle demand at the margin, which contributes to more inventory sitting longer. What analysts who track these markets are watching is not the retail pricing headlines, which tend to reflect conditions with a lag. They are watching days supply figures by segment and region. They are watching incentive per unit data, which tells a more honest story about actual transaction economics than sticker prices. They are watching auction conversion rates, the share of vehicles offered at wholesale that actually sell at the prices being asked, which is a sensitive indicator of where real market clearing prices are. And they are watching floor plan delinquency data, which begins to rise when dealers are having difficulty servicing their inventory financing obligations. When multiple of these indicators move in the same direction simultaneously, the stress they collectively signal is typically more advanced than the public narrative around the market has acknowledged. For the consumer watching all of this from the outside, the practical implication is straightforward. The distance between asking price and achievable deal price is wider right now than it has been in years in a growing number of market segments. The incentive money available through manufacturer programs, combined with the floor plan pressure on aging units, creates a negotiating environment that rewards informed, patient buyers who understand what the underlying economics of a specific transaction actually look like. This requires doing some homework before walking onto a lot. Know what day supply looks like for the model you are considering. Know what the current incentive programs are, not just the ones being advertised, but all of them. Know what comparable transactions are actually closing at, not what the sticker says. That information is more accessible than it used to be, and it is the foundation of a negotiation that reflects the actual market rather than the presentation of it. The brand new car that has been sitting on a dealer lot for 4 months is not just a slow seller. It is a data point in a system that is carrying more stress than the showroom presentation suggests. The floor plan interest is compounding. The margin is eroding. The manufacturer's incentive budget is being drawn down. The used market is being supplied with the downstream flow of fleet vehicles and wholesale disposals. And the consumer credit quality supporting the purchase of new vehicles at current prices is deteriorating at the margins. None of these pressures resolve themselves quietly or gently once they reach a sufficient level. They express themselves through the mechanisms we have just walked through, and eventually, when those mechanisms are exhausted, through price adjustments that the market can no longer avoid. Watch the inventory, watch the incentives, watch the credit conditions, because when brand new cars stop moving, the system does not simply wait patiently for demand to return. It adjusts. And the adjustment, when it comes, is rarely as gradual or as orderly as the people inside the system prefer to describe